Look at the screen. On your left, the archives of May 15th, 1911. Newspaper headlines in bold, black ink screaming the death of Standard Oil. On your right, a live terminal feed from today. The combined market capitalization of ExxonMobil, Chevron, and Marathon is spinning violently upward, crossing the $1 trillion mark. The math reveals a cold, impossible truth. The corporate corpse never died. It simply mutated into an unstoppable hydra, and nobody noticed the switch. If you genuinely believe that breaking up modern big tech conglomerates will solve wealth inequality, you are stepping directly into a century-old trap. What you are watching on the news right now is pure regulatory theater, a carefully constructed illusion designed to mask the actual concentration of power. Ignorance of this mechanism is a liability. If you do not understand how this sleight of hand works, you remain a passive victim in a continuous cycle of corporate restructuring. I'm going to hand over the auditor's ledger. We are going to apply modern forensic accounting protocols to a century-old crime scene. We will trace the exact paper trail of shares John D. Rockefeller held before and after the verdict. I will prove to you, mathematically, that antitrust laws are not the ultimate weapon against monopolies. They are the exact opposite. They are a catalyst for unprecedented elite wealth extraction. It is time to examine the evidence. The physical evidence begins here. A macro lens slides across the scarred surface of a mahogany boardroom table, coming to rest on a thick, bound legal document. The 1911 Supreme Court mandate. Dust motes dance lazily in the harsh, unforgiving light of the archive room. The camera pans down from the heavy legal rhetoric to something far more lethal. A handwritten financial ledger. It records Standard Oil's precise valuation in the final hours before the judge's gavel fell. To the forensic historian, this basement is not a dusty tomb. It is a crime scene waiting to be processed. Surrounded by humming microfiche machines and century-old tax documents, the researcher operates with cold, methodical obsession. A finger traces the faded ink columns. There is a quiet, visceral thrill in isolating a mathematical discrepancy buried beneath layers of bureaucratic protocol. The numbers on this page do not align with the official historical narrative we were all taught. Let us establish the timeline. The official record states that on May 15, 1911, the Supreme Court of the United States handed down a landmark ruling. They decreed that Standard Oil of New Jersey, the central nervous system of Rockefeller's empire, was in direct violation of the Sherman Antitrust Act. The verdict was unanimous and absolute. The state had legally classified the corporation not just as a business, but as an illegal conspiracy operating against the public interest. To understand the motive, grasp the massive scale of the suspect. At the time of the verdict, this corporate entity controlled over 90% of all refined oil flowing through the United States. They operated an ironclad logistics network spanning tens of thousands of miles of pipeline and rail. They did not just sell a commodity. They owned the physical physics of transportation, suffocating any competitor who dared enter. This was a machine of unparalleled efficiency. Standard Oil acted less like a traditional enterprise and more like a sovereign nation operating within American borders. They possessed their own intelligence networks, their own private diplomatic channels, and a treasury that rivaled the federal government. Through the investigator's lens, looking at the raw, geographical dominance of this cartel, the court's attempt to regulate them appears almost comical. You cannot simply fine an empire. The official press releases from 1911 read like a victory lap for democracy. The public narrative was aggressively marketed as a monumental triumph for the working class over the elite. The monolithic trust was ordered to be brutally dismantled into 34 distinct, autonomous, and theoretically competing entities. The court established a strict, unyielding deadline. The entire dismemberment protocol had to be completely executed within a mere 6 months of the verdict. Consider the sheer bureaucratic violence of that order. We are talking about fracturing a planetary-scale infrastructure overnight. The court demanded that the ledgers be ripped apart, the refineries segregated, and the management completely decentralized. Newspapers sold millions of copies printing the obituary of the monopoly. The public celebrated the end of an era, genuinely believing the beast had been slaughtered. But forensic accounting relies on ledgers, not newspaper headlines. This is where the paper trail begins to contradict the official alibi. When you cross-reference the court transcripts with the actual asset distribution logs, a chilling anomaly emerges from the data. If the corporation was truly destroyed, its financial beneficiaries should have suffered catastrophic losses. But the historical archive shows no panic in the private bank accounts of the primary stakeholders. There is no evidence of capital flight. The silence in the data is deafening. To the untrained eye, this looked like the absolute, uncompromising destruction of an invincible empire. But when the forensic historian isolates the fine print of the ruling under magnification, the illusion shatters. Buried deep within the thousands of pages of legal mandates lies a glaring, almost elegant loophole. It was a structural glitch so profound, so perfectly engineered, that it would completely rewrite the foundational rules of global finance for the next century of trading. They did not execute the monopoly. They forced it to weaponize its own architecture. By mandating asset distribution, the legal system inadvertently handed the cartel the blueprint to become invisible. The court focused entirely on the physical assets, the derricks, the pipelines, while ignoring the abstract mathematical reality of equity ownership. Regulators were playing checkers, while the monopoly played three-dimensional chess. We are looking at the ultimate corporate crime scene. This was a company so impossibly large, so deeply entangled with the survival of the American economy, that it essentially functioned as a shadow government. And yet, this colossal entity was suddenly ordered by the highest court in the land to commit financial suicide on the public stage. The gavel struck, the decree was issued, and the monopoly obediently laid down its arms. Or so the official history books would have you believe. But corpses do not generate dividends, and dead empires do not conquer the future. As we dig deeper into the transaction logs of the newly formed entities, the investigator's suspicion becomes a mathematical certainty. The dismemberment was not a punishment. It was an incubation phase. How did the supreme legal authority of the United States accidentally engineer a wealth multiplier that makes today's billionaires look like amateurs? To find the killer, we must follow the black blood. We open the ledger just seconds before the gavel falls. The ink is still fresh on the valuation of the parent company. I am standing before a forensic timeline on a glass board, tracing the final pulse of a supposedly dying giant. This is the autopsy report of an empire, and the numbers do not lie. To find the killer, you have to establish the motive, and the motive is always buried in the initial capital allocation. Look closely at the primary beneficiary listed on this century-old tax document. Before the forced liquidation, John D. Rockefeller personally held exactly 256,854 shares of the central holding entity. In a modern corporation, ownership is diluted across millions of anonymous institutional portfolios, But here, the paper trail leads directly to a single signature. That specific sum of paper equated to exactly 24.9% of the total outstanding stock. In the clinical mathematics of corporate governance, you do not need 100% to rule absolutely. A concentrated block of that magnitude grants absolute veto power over the board of directors. Every strategic directive, every clandestine merger, every drop of crude oil moving across the continent required his implicit authorization. But to understand why this specific configuration of equity was so lethal, you must look at the physical map of the United States. Behind the glass board, the continent is essentially painted black. Red strings connect isolated refineries to sprawling holding companies across different states. You cannot kill a beast until you understand its anatomy, and the anatomy of this trust was completely misunderstood by the prosecutors trying to destroy it. The critical error the legal system made was assuming this was an energy company. The genius of the cartel was never about drilling for crude. The extraction of oil is messy, unpredictable, and highly competitive. The true power lay in the absolute monopolization of logistics. They controlled the ironclad tank cars and the thousands of feet of subterranean pipe silently entering every major industrial city. This was not a business of finding resources. It was a business of controlling movement. When you control the arteries of a nation, you control its heartbeat. The physical infrastructure was the weapon. If an independent prospector struck a massive well, it meant absolutely nothing if they could not transport the crude to a refinery. The trust simply waited at the toll booth. By monopolizing these physical transportation routes, the syndicate executed an extortion racket of unprecedented scale. They possessed so much logistical leverage that they forced the major railroads to pay them secret rebates. Think about the audacity of that transaction. They were not just securing a cheaper shipping rate for themselves. They were legally forcing the transportation networks to hand over cash every time a competitor shipped a barrel. It was an invisible tax levied on the very act of competition. Every time a rival attempted to bring their product to the open market, they were unknowingly subsidizing the cartel. The paper trail reveals a perfect feedback loop of financial destruction. They systematically taxed their own competitors into bankruptcy, buying up the distressed assets for pennies and seamlessly integrating them into the black logistical web. This is the operational reality of the beast the Supreme Court thought they were executing. You look at the evidence, the thousands of miles of steel pipe, the secret railroad kickbacks, the absolute dominance of supply chains, and you realize something terrifying. The court mandate only addressed the symptoms, not the underlying disease. They looked at a vast physical empire and assumed that breaking it into pieces would dilute its power. But the investigator knows that true power is not made of steel or oil. It is made of equity. The physical assets were merely the outward manifestation of a mathematical formula. By focusing their legal strike on the logistics networks, the regulators completely missed the invisible architecture holding it all together. They severed the arteries, but they left the central nervous system entirely intact. Return to the ledger in those 256,854 shares. That paper represented an algorithm of control. When the gavel ordered the physical dismemberment of the company, it did not erase the fundamental ownership of the infrastructure. The holding company was a legal fiction, a convenient shell to house the actual mechanism of wealth extraction. And that mechanism was about to mutate. The archive documents proved that the architects of the monopoly did not panic when the verdict was read. They understood a foundational rule of economics that the judges had entirely overlooked. If you hold an absolute chokehold over an entire continent's energy supply, dividing that chokehold into 34 distinct pieces does not create free market competition. It creates 34 highly synchronized financial weapons. As the investigator connecting the strings on this glass board, the horrifying elegance of the crime becomes clear. The government believed they were dismantling a bomb. In reality, they were merely removing the outer casing, exposing a decentralized network of explosives that could no longer be diffused. The anatomy of the trust was about to be weaponized by the very laws designed to destroy it. Step away from the map of logistics routes with its black veins of pipelines and walk into the printing room. The air here smells of fresh ink and hot iron. The rhythmic, mechanical sound of stamping machines echoes off the brick walls. You are witnessing the exact legal mechanism the government deployed to break apart those monopolized routes. The state believed they were executing a corporate leviathan, but the executioner's axe was essentially just a printing press. To the forensic historian, this room is the scene of a magnificent illusion. The illusion of destruction. We are taught that the Sherman Antitrust Act shattered the monopoly, crushing the billionaire class under the weight of federal law. But watch the mechanical arms of these stamping presses closely. Chopping a monolithic financial entity into pieces does not destroy its mass. It only exponentially multiplies its surface area, creating a hydra that is impossible to track. Look at the sheer volume of paper flooding off the line. Certificates bearing names like Standard Oil of New York and Standard Oil of California are piling up in heavy stacks. The Supreme Court mandate did not seize the assets or nationalize the refineries. Instead, the legal protocol required the parent company to execute a highly specific financial maneuver. They were ordered to distribute the shares of the newly created 34 subsidiaries directly to their current stockholders. Follow the paper trail, and the detective work reveals the fatal flaw in the prosecution's logic. The distribution was legally mandated to occur on a strict pro-rata basis. This meant the ownership structure was essentially cloned, not dismantled. For every single share of the original, centralized monopoly you kept in your vault, you automatically received a corresponding fractional share in all 34 of the newly minted, supposedly independent corporate entities. You trace the ledger entries, and the numbers quickly descend into absolute madness. The courts demanded total dismemberment, forcing corporate accountants into a mathematical nightmare. To divide the vast assets of the parent trust perfectly among existing stakeholders, they sliced the new equity into microscopic slivers. The ledgers from 1911 look less like financial documents and more like theoretical physics equations. Dig into the deepest archives, and you find the physical evidence of this absurdity. Stockholders were literally receiving paper certificates representing fractions down to 994 almost millionths of a single share. They were holding less than 1/10,000th of an obscure pipeline operator in Ohio or a tiny barrel-making facility in Pennsylvania. The government forced a bureaucratic fragmentation so severe that it became impossible for any regulator to monitor. As an investigator, when you see complexity deliberately engineered to this degree, you know you are looking at camouflage. The microscopic fractions were a smokescreen. The American public read the headlines and cheered, believing the oil baron had been stripped of his empire. But the microfiche records show no evidence of asset forfeiture. The oil derricks, the tank cars, the massive refineries, none of it was handed over to the state or sold off to independent competitors. This is the smoking gun buried in the federal archives. Crucially, the government never forced John D. Rockefeller to liquidate a single ounce of his actual holdings. They did not impose a wealth tax, and they certainly did not make him pay a punitive financial penalty for decades of illegal collusion. They simply forced a massive administrative equity swap. The legal system confiscated absolutely nothing from the architect of the monopoly. The transaction was beautifully sterile. The state simply swapped his single, highly visible, massive piece of paper for a decentralized portfolio of 34 distinct pieces of paper. To the court, this satisfied the definition of dissolving a trust. But to the forensic accountant, it is clear that the underlying capital never shifted. The exact same individuals owned the exact same infrastructure. They just held it through 34 different corporate aliases. The rhythm of the stamping presses in this room is the heartbeat of a new financial era. The 1911 ruling essentially taught the American elite a masterclass in obfuscation. If a singular, towering corporation attracts the ire of antitrust regulators and the fury of the working class, you do not fight the law. You use the law to shatter your visible monolith into a swarm of invisible, intersecting shell companies. You trade the crown for a web. The anomaly is staring us right in the face. A punitive legal judgment is designed to inflict damage, to reduce the operational capacity and the net worth of the guilty party. But sift through the tax documents of the major shareholders in the months immediately following the dissolution. The capital does not shrink. It does not even stagnate. It prepares to detonate. The paper fragmentation acted as a catalyst, stripping away the heavy bureaucratic drag of the parent monopoly. You follow the money, and the paper trail reveals a terrifying truth. By forcing the trust to dissolve into 34 supposedly competing entities, the Supreme Court inadvertently built the perfect wealth generation engine. The legal fiction of separation allowed these new companies to operate with ruthless, localized efficiency, while their actual ownership remained deeply entrenched in the hands of the original few. The elite were no longer a target. They were a diversified portfolio. The stamping machines finally powered down, leaving behind mountains of freshly minted equity. The public believed the monopoly was dead and buried, but as you cross-reference these 34 new stock tickers with the upcoming market data, a chilling pattern emerges. The decentralized network is breathing. The fractional shares are beginning to interact with the free market, and they are about to trigger the most violent, legally sanctioned upward transfer of wealth in modern history. The decentralized network is breathing, yes. Those 34 fractional shares from the Supreme Court mandate did not just sit in vaults. They hit the open market. I'm standing on the floor of the New York Stock Exchange in December 1911. The air is thick with cigar smoke and the frantic clicking of the telegraph. The ticker tape is spilling onto the floor, coiling like a serpent around the ankles of the brokers. Look closer at the numbers printing on that paper ribbon. Through the cynical eyes of a quantitative commodities analyst, the tape tells a story that defies the very laws of financial gravity. A punitive legal judgment should trigger a massive sell-off, panic, liquidation. But the aggregate value of these newly birthed baby standards is not crashing. It is climbing at a terrifying near-vertical angle. The anomaly is absolute. The government believed they had slain the beast. But if you sever the head of a truly apex corporate predator, you do not get a corpse. You get 34 new heads, and they are infinitely hungrier. The public cheered for the destruction of the monopoly, completely blind to the mathematics of what was actually unfolding on the trading floor. We are witnessing the birth of the greatest unintended consequence in economic history. To understand this explosive growth, you have to look at the structural flaw of the original trust. Standard Oil was a monolithic, opaque empire. It was so massive, so heavily layered in bureaucratic sediment, that the free market could not accurately price its individual assets. The true value of its refineries, its pipelines, and its tanker fleets was buried deep inside a black box of corporate accounting. Wall Street has a term for this phenomenon: the conglomerate discount. When a massive parent company hoards diverse, highly profitable assets, investors tend to undervalue the whole compared to the sum of its parts. By forcing the dissolution, the Supreme Court took a sledgehammer to that black box. They did not destroy the value, they exposed it to the light of day, forcing the market to reevaluate every single pipeline and oil derrick. Suddenly, these 34 agile offspring were free from the heavy bureaucratic drag of the central monopoly. They no longer had to subsidize the less profitable branches of the empire. A refinery in New Jersey or a distribution network in California could now be priced at its true, explosive market value. The legal dismemberment acted as a financial accelerant, pouring gasoline on a smoldering fire of hidden corporate equity. The statistics from the trading floor are staggering. Within exactly 1 year of the 1911 dissolution, the combined market capitalization of those fractured companies doubled. 100% growth in 12 months, triggered entirely by a government penalty. And the momentum did not stop there. By 1913, that aggregate valuation had completely tripled. The sum of the severed parts became a financial leviathan. Now, follow the money back to the architect. John D. Rockefeller owned roughly 25% of the original trust. Before the gavel fell, his personal net worth hovered around $300 million, a staggering fortune for the era, but constrained by the conglomerate discount. When the court forced him to hold 34 separate equity portfolios instead, the market correction directly inflated his personal ledger. 2 years. That is all it took. By 1913, propelled by the tripling of the baby Standard's market capitalization, Rockefeller's net worth skyrocketed to nearly $900 million. He became the world's first billionaire not by building a new product, but because the United States government legally mandated the optimization of his equity. The antitrust legislation functioned as a massive, involuntary wealth multiplier. You have to appreciate the profound irony of this crime scene. The prosecutors, the judges, the cheering public, they all believed they were dismantling an economic tyrant. But the analyst watching the ticker tape knows the cold truth. The law cannot destroy capital. It can only force capital to restructure into a more efficient, decentralized state. The punishment was, mathematically, the greatest gift Rockefeller ever received. This is the genesis of the modern financial matrix. The illusion of regulatory control masking the hyper-concentration of actual wealth. As the ticker tape piles up on the exchange floor, a new reality sets in. The original trust was a slow, visible target. These 34 new entities are fast, legally protected, and drowning in newly liquefied capital. And this freshly minted paper wealth is about to become heavily weaponized. Paper wealth, no matter how mathematically impressive, is merely potential energy. It is a promise written in ink, trapped in the ledgers of Wall Street. For this staggering tripling of market capitalization to alter the physical world, it must be converted. The brokers on the floor are not just trading abstract fractions. They are unlocking a flood of liquidity that will soon overwhelm the banking sector and redefine global power. The quantitative analyst steps over the mounds of ticker tape. The numbers have spoken, completely invalidating the Supreme Court's intent. The monopoly is dead, but the cartel is awake, flush with a 300% increase in market power. The next step in this forensic audit is tracking where this massive, unexpected windfall goes. Because when a $900 million fortune liquefies, it buys much more than just oil. Because when a $900 million fortune liquefies, it buys much more than just oil. But we need to follow the paper trail. Look closely at this gold fountain pen gliding across the thick parchment of a dividend check. This is the exact moment potential energy becomes kinetic. Paper wealth, no matter how mathematically impressive, is merely a ghost. It only becomes a weapon when it flows. And right now, the ink is flowing like black blood, signing away fortunes in a windowless room. The forensic historian watches the clerks load stacks of heavy envelopes into reinforced leather mailbags. Each envelope represents a fraction of the newly shattered monopoly. The Supreme Court thought they had severed the head of the beast, but they merely triggered a massive bleeding of capital, straight into the pockets of the exact same beneficiaries. Paper wealth is entirely useless until it moves. We're going to follow this dividend stream down into the dark, right to its absolute source. You have to ask yourself a foundational investigative question. Why the sudden flood of liquidity? Before 1911, the massive parent trust operated like a financial black hole. It swallowed capital, hoarding profits deep inside a labyrinth of opaque corporate structures, specifically to avoid taxation and public scrutiny. The money was trapped. But the judge's gavel shattered that containment vessel, forcing the capital out into the open air of the free market. Suddenly, these 34 newly independent entities were flush with raw, unattached capital. They no longer had the massive bureaucratic umbrella of the central trust to hide their astronomical profits. Exposed to the light, they had only one mathematically viable option. They began issuing massive, unprecedented cash dividends. The financial floodgates were blasted wide open by the very law designed to keep them shut. I found the actual distribution ledgers in the basement archives, and the numbers read like a confession. The sheer volume of outgoing capital is staggering. We are not talking about reinvestment or infrastructure development. We are looking at a direct, systematic extraction of wealth from the corporate accounts directly into the private, heavily guarded bank vaults of the controlling elite. The money is moving with ruthless, synchronized efficiency across all 34 independent companies. Let us look at the exact paper trail for the fiscal year immediately following the dissolution. In 1912 alone, these former subsidiaries paid out over 40% of their net earnings directly to their shareholders. 40%. That is a catastrophic hemorrhaging of corporate capital, intentionally funneled straight back to the original major architects of the monopoly. They were draining the blood of the fractured companies to feed themselves. When you examine the recipient logs, the illusion of decentralized ownership completely collapses. The lion's share of this unprecedented cash payout did not go to the American public or independent investors. It flowed with magnetic precision directly to John D. Rockefeller and his inner circle. They held the fractional shares, so they collected the fragmented dividends. The Supreme Court essentially mandated the largest, most aggressive dividend payout in modern financial history. This is the absolute smoking gun. The moment you realize that antitrust legislation was the exact mechanism that liquefied the greatest private fortune on Earth. If this scale of historical financial manipulation blows your mind too, hit the like button and subscribe. Let me know in the comments if you think the regulators even understood the math they were dealing with. Because the forensic evidence proves they handed the ultimate victory to the very men they were trying to prosecute. Follow the leather mailbags down the heavily guarded elevator shaft, deep into the private bank vault. This is where the dividend checks are cashed, where the paper ghosts materialize into terrifying economic power. The forensic historian sees the final destination of the 1911 mandate. You cannot build a modern empire with oil alone. You need liquid capital, untethered from the slow, physical reality of pipelines and refineries. And now, they had an absolute ocean of it. This sudden, tidal flood of cash allowed the same handful of elites to quietly pivot. They took their newly liquefied wealth and began aggressively diversifying. They bought controlling stakes in major commercial banking institutions. They purchased the very railroads they used to extort. They swept up prime commercial real estate across the country. The breakup of big oil was the exact financial catalyst that allowed them to literally buy the rest of the American economy. The true genius of this crime is its total invisibility. When you control a single oil monopoly, you are a massive, slow-moving target for every politician and investigative journalist in the country. But when you control 34 fragmented companies, while quietly buying up the banks that fund their competitors and the railroads that ship their products, you disappear. You become the environment itself. The target vanishes, replaced by an omnipresent financial architecture. I trace the signatures on these transfer documents, and the modus operandi becomes chillingly clear. They did not just survive the antitrust ruling. They weaponized it. They used the legal dismemberment of their company to execute a massive, systemic buyout of the nation's core infrastructure. By forcing them to decentralize, the state inadvertently taught them how to become untouchable. The monopoly was dead, but the invisible oligarchy was just drawing its first breath. The investigator closes the ledger, the dust settling in the harsh archival light. The money has been tracked, the motive exposed, the beneficiary identified. But having liquid capital is only one piece of the puzzle. To truly dominate a continent, you must ensure your newly fragmented companies never accidentally compete with one another. We need to look at the map, because the next piece of evidence proves the free market they created was nothing more than a tightly controlled cartel. We track the newly minted liquid capital out of the private vaults and project it onto a glowing, continent-wide map of the United States. The investigator's gaze shifts from bank ledgers to the actual consumer battleground. The 1911 Supreme Court mandate promised a brutal free market war for your dollars. We are looking for the chaos of competition. We are looking for overlapping territories, aggressive expansion, the bloody corporate warfare the politicians guaranteed. But the evidence on the glowing glass board shows an impossible anomaly. You look at the neon lines representing the distribution networks of the 34 newly formed companies. Standard Oil of Indiana turns bright green. Standard Oil of New York illuminates in cold blue. The borders between these supposedly warring factions are absolute, rigid, perfectly delineated. The colors never mix. The great lie of antitrust legislation is unfolding right in front of us. The protocol of the dissolution was fundamentally flawed. The judicial gavel created competition exclusively on paper. In the physical reality of dirt, steel, and consumer markets, The 34 offspring inherited highly distinct, non-overlapping geographic monopolies. You were told the Leviathan was slain to protect you, the consumer. Instead, the autopsy reveals the beast was simply carved into regional fiefdoms, each ruling its designated territory with total impunity. Let us examine the geographical evidence. Standard Oil of California retained absolute, uncontested dominance over the entire West Coast market. Standard Oil of Ohio maintained an undisputed stranglehold across the industrial Midwest. To the untrained observer, it looked like 34 separate logos. To the forensic accountant, it is a masterclass in market segregation. They did not have to compete because they were explicitly designed to never cross paths in the first place. The paper trail shows no formal treaties, no signed non-compete clauses. They did not need them. There was a tacit, unwritten agreement woven into the very DNA of these newly severed entities. You do not lay pipelines across state lines into a brother company's territory. Building infrastructure is expensive and leaves a glaring physical footprint. Why spend millions digging trenches to fight a price war against your former colleagues when you can just comfortably dominate your own zone? This is the exact moment the legal theory of antitrust collides with the cynical reality of forensic economics. If you are a farmer in Ohio in 1913, you cannot buy California oil. You have one option, at one price, dictated by one regional board of directors. The illusion of a free market is maintained purely by the existence of other companies on a map, companies that you, the consumer, are geographically forbidden from ever doing business with. And here is the fatal consequence for the American public. Under the old illegal monopoly, the centralized parent company frequently used its massive scale to artificially lower prices, systematically crushing independent local rivals. It was a brutal, predatory tactic, but it ironically kept the cost of fuel cheap for the end user. The 1911 mandate permanently removed that central mechanism. It removed the only reason the cartel ever had to keep retail costs down. Without the parent company constantly suppressing prices to starve out wildcat competitors, the new regional kings were completely unleashed. The so-called baby standards simply raised gasoline prices across the board for the American consumer. The economic data is merciless. Within a few short years of this supposed regulatory triumph, these regional monopolies boosted their baseline profit margins by over 15%. The consumer paid for the illusion of a dismantled trust. Look back at the neon borders on the map. This was never a competitive market. It was a synchronized extraction grid. The politicians held their press conferences, declaring victory over corporate greed, while the quiet architects of this system successfully passed the entire cost of the legal restructuring onto the public. You celebrate the death of a single tyrant, only to be seamlessly handed over to a syndicate of 34 regional warlords who never intend to fire a single shot. The investigator traces the flow of capital from these newly inflated gasoline prices right back into the regional headquarters. The motive of this specific crime is brilliant in its simplicity. If the state forces you to divide your army, you simply assign each division its own continent. You neutralize the threat of internal cannibalization. The Supreme Court did not dismantle a monopoly. They accidentally optimized a sprawling, highly efficient cartel. But geographic isolation is a fragile piece. Eventually, human greed dictates that one regional king will try to cross the border and steal a brother's crown. The fact that this never happened, that the map remained perfectly stagnant for decades, suggests a deeper layer of invisible control. To understand how 34 independent companies maintained absolute discipline without ever speaking a word, we have to pull the camera back and look closely at the men sitting in the boardrooms. The geographic isolation of these 34 regional monopolies presents a statistical impossibility. To the quantitative commodities analyst reviewing the historical data, a stagnant map with zero border incursions for decades screams of collusion. Markets are naturally predatory. When 34 independent corporations suddenly decide to respect invisible lines on a map, you are not looking at free enterprise. You are looking at a perfectly executed truce. Step inside the data architecture of this supposed competitive market. The analyst models a dark, cavernous room containing the boards of directors for all 34 newly birthed oil companies. We expect a crowded auditorium of bitter rivals plotting each other's demise. Instead, as the ownership algorithms process the archival ledgers, ghostly silhouettes fade into the empty seats. The anomaly reveals itself. As the perspective shifts across the digital simulation, a cynical truth emerges from the math. It is the exact same 5 men sitting in every single chair across all 34 supposedly independent companies. This is the invisible web of the 1911 dissolution. We are observing how an oligarchy legally colludes without ever speaking a single word on the record. The corpse of the centralized monopoly was nothing more than a decoy. The Supreme Court justices made a fatal structural error in their mandate. They forced the division of the corporate entity, but completely ignored the concept of horizontal shareholding. The evidence in the shareholder registry is damning. Rockefeller and his closest associates still collectively owned a majority voting bloc in every single one of the new, fractured offspring. The legal entity was dead, but the underlying ownership remained utterly intact. This parallel ownership structure generated a profound mathematical alignment. Even without formal communication, the distinct boards of directors intuitively synchronized their operations. The quantitative analyst tracks the production quotas and pricing strategies across different states. They perfectly mirror each other. No secret meetings or smoke-filled back rooms were required. The ledgers themselves dictated a unified strategy of extraction. To the investigator following the money, the motive is baked directly into the calculus of the shares. When the exact same beneficiaries hold the ultimate purse strings, the concept of corporate warfare becomes an absolute absurdity. You do not fund an army to attack your own citadel. The court demanded competition, but the underlying financial reality made that legally mandated conflict physically impossible to execute. The system protected itself. The logic of this shadow cartel is flawless. If you own 30% of Company A and 30% of Company B, you will never allow them to enter a bloody price war. Driving down the cost of gasoline to win market share in Ohio only destroys your own massive dividend payouts from California. Instead, you ensure both entities extract absolute maximum value from their captive regional markets. You simply weaponize the government-mandated peace. This is the brilliance of the architecture. There is no paper trail of conspiracy because the conspiracy is simply rational market behavior. The quantitative analyst notes the sheer efficiency of this setup. The executives running these subsidiaries did not need direct orders from Rockefeller. They only needed to look at their own capitalization tables to understand exactly who they truly served. The financial structure itself was the invisible hand. By shattering the monolithic target, the legal system inadvertently forged a much stronger weapon. The new, decentralized network proved infinitely more resilient than the old, centralized monopoly. it became completely impervious to single-point legal attacks. You cannot sue a central headquarters for price fixing when that headquarters no longer exists. The regulatory state was fighting a phantom. The antitrust mandate was essentially a stress test that the cartel passed with flying colors. The monopoly no longer lived in a vulnerable, tangible corporate charter. It existed purely in the shared financial interests of its top shareholders. This decentralized equity grid acted as an impenetrable shield. If a prosecutor attacked one regional node, the other 33 continued to pump cash dividends upward without missing a single beat. The analyst watches the historical data streams solidify into a permanent, unbreakable structure. The 1911 ruling did not break the machine, it merely hid the gears underground. This horizontal shareholding exploit became the ultimate blueprint for unaccountable power. And as we map this century-old architecture, a terrifying realization sets in. This is not just history. This is the exact source code running our modern economy. The quantitative analyst looks away from the 1920s handwritten ledger. The ink has faded, but the underlying mathematical logic remains bulletproof. The scene hard cuts. We are no longer in a dusty archive. The harsh, sterile glow of a modern Bloomberg terminal illuminates the windowless server room. High-frequency trading algorithms flash across the screen in a blur of red and green. The architecture of the cartel did not die. It merely digitized. The exact same source code that ran the oil monopolies of the 20th century is currently executing millions of transactions per second. I track the digital paper trail as the historical names of the baby standards vanish from the terminal. They are instantly replaced by the three massive institutional megafunds that dominate 2026. The virus born from that Supreme Court ruling did not just survive. It mutated into something far more virulent. This is the perfect financial crime scene, because no one even realizes they have been robbed. The 1911 breakup became the master blueprint for the modern corporate oligarchy. You are living inside the upgraded version of this system right now. Every time you swipe your debit card, you are interacting with a decentralized, untraceable network of equity that was designed precisely to extract your wealth while maintaining the illusion of a free market. To the untrained eye, the stock market looks like a chaotic battlefield of fierce competition. But the analyst filters out the noise of daily trading volume and isolates the ultimate beneficiaries. The screen reveals a terrifying symmetry. Massive institutional investors are employing the exact same horizontal shareholding strategy that Rockefeller perfected. They do not need to own a monopoly outright. They just need parallel stakes across the entire sector. Let me pull the forensic data for the airline, pharmaceutical, and banking industries in 2026. In almost every case, the top three asset management firms hold dominant, parallel stakes in every single supposedly competing corporation. They collectively control over $22 trillion in assets. If you fly on a major carrier or deposit a check at a massive commercial bank, the exact same three financial behemoths are taking a cut of the transaction. Look closely at the commercial aviation sector. The analyst pulls up the capitalization tables for the top four airlines, which control over 80% of domestic flights. The exact same institutional funds are the largest shareholders in all four. Just like the regional oil monopolies, they have zero financial incentive to trigger a devastating price war over baggage fees or ticket costs. They simply demand synchronized capacity discipline across the entire industry. By deliberately decentralizing ownership across an impenetrable web of mutual funds, index trackers, and shadow banks, true financial control becomes mathematically invisible. Traditional antitrust regulators are still looking for a single villain in a boardroom, completely oblivious to the fact that the collusion is happening at the structural level of the algorithm. You cannot issue a subpoena to an overlapping capitalization table. The regulators are structurally blind. The quantitative analyst watches the high-frequency trades execute, confirming that the cartel exists purely in the math. When a regulatory agency tries to map this modern network, they drown in a sea of dummy corporations and proxy voting protocols. The 1911 mandate taught the elite that visibility is vulnerability. Modern financial architecture is designed specifically to ensure that the ultimate concentration of capital never triggers a legal tripwire. Walk down the aisle of any American supermarket today. The shelves are packed with hundreds of vibrantly colored brands, offering you a dizzying array of consumer choices. But the analyst traces the corporate genealogy of those products backward. The paper trail reveals that nearly every box, bottle, and jar is produced by roughly 10 mega-corporations. And those 10 mega-corporations are entirely owned by the exact same matrix of institutional asset managers. This vibrant supermarket aisle is nothing more than a massive psychological operation. The illusion of choice masks the cold, hard reality that all the dividends flow upward to the exact same digital vaults. Whether you buy the premium brand or the generic alternative, your money ultimately lands in the exact same offshore account. The system forces you to participate in a rigged game where the house never actually loses, because the house owns all the players on the board. The glowing red lines on the Bloomberg terminal form a flawless, inescapable web around the globe. The investigator realizes the chilling truth. The 1911 verdict was not a punishment. It was an evolutionary leap. We spent a century believing we had slain the great monopolies, while in reality, we simply forced them to become omnipresent. The trap has snapped shut, and the architecture of absolute control is now quietly operating in the background of our daily lives. Look down at the harsh, violent burn of flare stacks against the twilight sky. We are hovering above a massive modern oil refinery, sprawling across the landscape like an iron city. But as our perspective pulls back, higher into the stratosphere, the smoke and steel begin to blur. The pipelines and storage tanks compress, transforming before our eyes into the intricate, glowing pathways of a silicon microchip. The physical infrastructure of the 20th century is now just a node in a global, inescapable machine. A forensic historian and quantitative analyst have closed their ledgers and logged off their terminals. Their investigation is complete, but the implications of what they found rest entirely on you. We spent a century operating under a comforting illusion. We believed that if a corporation grew too large, too predatory, the legal system would simply step in and shatter it. We thought the 1911 Supreme Court verdict was a triumph of democracy over the cartel. We were completely wrong. The final verdict is in, and the evidence is irrefutable. The forced dissolution of Standard Oil was not the death of a monopoly. It was a catalyst for its survival. By ordering John D. Rockefeller to shatter his empire, the government inadvertently forced a massive, lumbering beast to evolve into a form of financial dark matter. The cartel did not die. It simply retreated into the shadows of decentralized equity, becoming an invisible force that dictates the gravitational pull of the entire global economy. The mathematics of this transformation are devastatingly simple, yet completely misunderstood by the public. John D. Rockefeller did not become the world's first billionaire in spite of the antitrust ruling. He achieved that historic milestone precisely because the government forced him to unlock the hidden, decentralized value of his opaque empire. The judge's gavel did not confiscate his wealth, it liquefied it, allowing his capital to flow freely into the veins of banking, railroads, and real estate. For over 100 years, we have been living inside this architectural blueprint, mistaking regional warlords for free market competitors. The invisible web of horizontal shareholding proved exponentially more resilient than any centralized holding company. It is a system impervious to legal attack because the collusion exists solely in the mathematical alignment of mutual funds and asset managers. The boardrooms may look different, but the dividends all flow upward to the exact same digital vaults. This is the psychological trap that continues to ensnare modern regulators. When politicians stand at podiums today and boldly threaten to break up the massive tech conglomerates of Silicon Valley, they are not threatening the elite. They are merely reading from a century-old script threatening to trigger the exact same wealth multiplier that enriched Rockefeller. Dividing a digital empire into 34 supposedly independent platforms will only multiply their aggregate market capitalization. The system we uncovered is not broken, and it never was. It is operating exactly as designed. The ultimate trick of the modern oligarchy was convincing the public that fragmentation equals competition. But breaking a mirror does not change the reflection. It just multiplies the angles from which you are watched. As long as the underlying ownership remains consolidated in the hands of a few institutional behemoths, the illusion of choice will continue to mask the reality of absolute control. We must discard the comforting fairy tale that the law can easily tame capital. The history of antitrust is essentially a history of forced mutation. Every time a regulatory agency attempts to crush a monolithic entity, capital simply adapts, learning to camouflage itself within the complex legal structures of the era. The beast sheds its skin and emerges sleeker, faster, and infinitely more difficult to track. You are not witnessing the regulation of power. You are witnessing its optimization. This realization changes the very nature of how you must interact with the modern world. You are navigating an environment where the true centers of power have legally insulated themselves from consequence. The food you buy, the media you consume, and the digital platforms you rely upon are all nodes in that exact same microchip we saw glowing in the twilight. Your participation in this system is mandatory, but your blindness to its architecture is a choice. The true value of forensic accounting is not just solving the crimes of the past, but recognizing the traps of the future. If this investigation shattered your perception of corporate power and gave you a new optic on reality, hit the like button to confirm we are exposing the right vulnerabilities. Subscribe to this channel, not just to watch another documentary, but to continue the audit. The ledger remains open, and we need every analytical mind to decode the next structural mutation. The ultimate truth of this investigation is cold and uncompromising. Capital cannot be destroyed by a judge's gavel. It merely adapts, fragments, and tightens its invisible grip on reality. We have mapped the architecture of the modern oligarchy, proving that true power never perishes, it simply digitizes. The case of the 1911 monopoly is officially closed, but the machinery it birthed is humming all around you. Live with it. Signing off.